Learn to Earn by Peter Lynch. Before going into the summary of this book and going into the mind maps, I want to tell you an insane fact about Peter Lynch. Peter Lynch was the fund manager of Magellan Fund, an American fund house, and Peter Lynch generated annual rate or annual growth of 29.2% compound annual growth rate CAGR from 1977 to 1990, and that is insane. Okay, and that's why he is also considered as one of the top investors of all time, one of the best investors of all time. So today we are going to see the summary of one of his famous book that is named as Learn to Earn, and we are going to see the book summary using an interactive mind map. So first of all, what is the introduction of the book? First of all, what introduction? Then basics of capitalism, understanding stocks, how companies grow. Then the author tells us about the stock market. Then book deals with investing principles, benefits of investing, and then what are the final thoughts of the book. Okay, so first of all, let's go into the introduction. Now in introduction, purpose of the book has been told. Purpose of the book is that teach readers the basics of investing and the stock market, and also encourage young people and beginners to start investing as early as possible. Okay, and then who should read it? Now people who are students, young professionals, and anyone new to investing should read it, and according to the people, those who are curious about new businesses and how capitalism work, those people should also read this book. So now next is the basics of capitalism. In basics of capitalism, we are going to see, or the book tells us about three things: that what is capitalism, and what are the importance of businesses, and what is the role of investors. So what is capitalism? See, in capitalism, or a capitalism is an economic system where individuals and companies own the means of production. Whatever the means of productions are, they are owned by individuals and companies. And secondly, it encourages innovation, competition, and private ownership. Then what is the importance of businesses? See, the importance of business is to drive economic growth by creating jobs and goods and services, and generate wealth for individuals and society, and especially those individuals who are actually creative, innovative, and hardworking. For those people, the businesses tries to generate wealth, more and more wealth. Okay, and what is the role of investors? The role of investors is to provide capital for businesses to grow. Otherwise, businesses or the big large businesses will not be able to grow on their own. Okay, that would be very rare. And share also, the investors also share in the success of companies through profits and stock appreciation. Not only success, I would say that in the failures also they have share. Okay, so they share what? They share the profit of the company and the stock appreciation. For example, today if you buy a stock, a company's stock at 100 rupees per stock, and then in 5 years it goes to 150 rupees, then what? Your profit is 50 rupees. This is what the role of investors is. Then understanding market. In understanding market, three topics are: what are stocks? The book tells us about what are stocks. The author says about why should we invest in stocks, and what are the common myths. So what are stocks? A stock represents ownership in a company. Okay, when you are having, if you are having a stock in a company, it means that you are one of the owner of that company. Any loss or any profit would be shared by you, shared with you. Okay, and shareholders have a stake in company's profits, assets, loss, liabilities, everything. Okay, so you are one of the owner of that company. Then why you should invest in stocks? The author says that historically, if you compare stocks with all the other investment asset classes, the stocks had almost outperformed every other investment. Okay, Historically, stocks have outperformed other investments, like people used to invest in, like people love to invest in bonds, gold, savings accounts. They all have been beaten by the stocks, and investing helps you build wealth over time through compounding. Here also, the importance of compounding has been pressed for, and investing helps you to build wealth, more and more wealth, generate more and more wealth by the uses of power of compounding. Okay, then what are the common myths? The common myths which generally revolves around the around in the society is that investing is gambling. It is, according to author, false. Informed investing relies on research and analysis, and not only luck, and not luck. Okay, so if you are investing on the basis of your own research, your own analysis, and you are trying to, or you are investing in qualitative, fundamentally strong companies, okay, then it is not uh, an informed decision. Then it is not a, that it is not a then there is no factor, not much factor of luck, and it is a very informed decision. Okay, and uh, you will be generating much wealth through that stock if you keep that stock for long term also. Okay, this is also a parameter, that you should hold a stock for much longer time, and it is only for the rich. Common myth is also that stock market is for the rich people. No, it is also false. Anyone can start small and grow their portfolio. This is what author says about these myths. Now, how companies grow? First of all, there are three ways which have been told in which a company grow. Okay, first is revenue and profit growth. In revenue and profit growth, companies increase sales by attracting more and more customers or raising prices. Either they are trying to attract more customers or they increase the prices, and that's how they make profit. And profit grow when costs are managed effectively. See, you just you not only have to, or a company not only have to elevate the prices of their products, but rather they also have to effectively manage the cost of production. Otherwise there won't be any profit. Okay, then the second way of company growth is expanding market share. In this, company innovate to offer better products or services, so that more and more people use their products. And competitive advantages, that is also called as moat. For example, brand loyalty. For example, we see the brand loyalty for Apple products. And for example, patents, these are what? These are moat. These help sustain growth. Okay, otherwise a company won't be able to sustain growth. A new company will enter and take huge much market share from a well established company. Well established means it is a competitive advantage. Okay, it means that it has a moat. Then reinvesting profit is also one of the way in which the companies grow. The companies use earnings to improve infrastructure, launch new products, and expand globally. And this reinvestment drives long-term growth. This reinvestment, a company makes profit, then reinvests, then makes profit, reinvest. This is how they grow. Okay, and become $1 billion companies, $1 trillion companies. Okay, then the stock market. In a stock market topic, author says that author deals with three things. That is also, what is the stock market? Here he says that a stock market is a platform where stocks are bought and sold. We all know, like NYSE. NYSE is what? New York Stock Exchange, or Nasdaq. Its full form is very trivial. I don't remember now. I used to remember it, but I don't remember now. Okay, Nasdaq. Nasdaq is also what? Is also an stock, is also a stock exchange. It facilitates the exchange of ownership between buyers and sellers. A stock market is a market where buyers and sellers of stocks meet and they buy and sell their stocks. Okay, this is what simply a stock market is. Then how the market works? See, stock prices are influenced by supply, that is, shares available for purchase, and demand, that is investor interest, that is shares, that is those people or those people who want to purchase some share. Okay, so by this it is influenced. Now prices fluctuate based on news, earnings and economic conditions. Prices fluctuate on which are the factors which influences the prices? That are news. For example, if some negative news comes in the newspaper about a company, the very next day the stock price of that company will fall. Okay, then what are the earnings? Quarterly reports, annual reports, all these things also uh, play a big role in deciding the price of the company. And what are the economic conditions? So for example, a complete ecosystem, if a country has good business ecosystem, then the companies will flourish and the stock market will also flourish there. Okay, and then what are the types of stocks? See, according to author or according to Peter Lynch, there are four types of stocks. One is common stock. Common stocks are those owners have voting rights and may receive dividends. They have voting rights, like they can vote in the big decisions of the company, and they also receive, they may or may not receive dividends. Then what are the preferred stock? Preferred stocks have fixed dividends but no voting rights, they don't have voting rights. Common stocks, or these are those owners who have substantial stake in the company, and that's why they have the right to vote in the big decisions of the company. Then there are third type, that is growth stocks. Those stocks focus on reinvesting profits for future growth. Okay, focus on reinvesting profits for future growth. And value stocks. What are value stocks? These are undervalued companies with potential for recovery. There are some companies which actually get temporary uh, they get temporary, some kind of temporary loss, and they have potential to recovery, and these are undervalued companies. These are value stocks, and these are the stocks which we need to find out. These are the best stocks. Why? Because first of all, those companies are undervalued, those stocks are undervalued, and they have also potential to recovery. Okay, because these are the stocks who will be making much profit for us. Then the next is, what are the investing principles which have been suggested by Peter Lynch? First of all, do your research. That is, understand the company's products. You need to understand what kind of product does the company manufacture or company makes, or what kind of services does it offer. Then what is the leadership, the management? Is it honest? Is it ethical? All these things are all these things have to be checked before you start to before you invest in a company. Okay, and what is the competitive position? For example, you also need to see their peers, their competitors, their earnings, their annual report, so that you can check that whether it has a substantial competitive advantage or not. And you need to analyze financials, for example revenue, for example profit margins, then debt levels. A company should not be much in a debt, otherwise it will go into debt trap and it will just get trapped there, and it will get bankrupt. Okay, and you also needed to check what are the growth trends, what are the market dynamics, what are the what is the uh, in which way is the world moving forward. Okay, all these things. Then you need to think long term. Focus on strong companies that can grow over years. You don't, not just months. You have to focus on strong companies, those companies who keep on growing continuously for years and even decades, not just months, because you have to hold those stocks for long term. In fact, personally, uh, I personally considered one of the quote by Warren Buffett sir best. That is, one day some reporter or somebody asked him that what is the good time to hold, what is the best time to hold a stock, and he said forever, that you should never sell a stock. Okay, you should invest only in those companies uh, which you are sure forever. Okay, you are sure that this company will never be able to, or it will be never going into the losses. Okay, and then you should avoid emotional reactions to market ups and downs. Here, see, the market is very moody, as told by Benjamin Graham sir. Market is very moody, it can go anytime up, it can anytime go down. Okay, so you should avoid those emotional reactions. You should, whenever the market goes down, that means whenever your stock price goes down, the stock which you have hold, it goes down, you should not be in a hurry to sell it, or you should not panic. You just keep doing your work. Okay, and stay away from stock market once you have like invested. And then diversification. Why? Because so that you can minimize the risk, spread your investments across sectors to minimize risks. You should not bet only on one sector or two sectors. Okay, you should allocate for example some portion of you should basically you should invest in multiple sectors so that you can minimize the risks. Okay, and then example is invest in technology, healthcare, consumer goods industries. Personally, I like consumer goods because these are the industries which are, I probably think, never ever going to fail. In technology, there are very less chances that to of prediction. For example, whether this company will be a hero or that company will be a hero, it is a big thing to say anything. Okay, in healthcare too, I think. But in the consumer goods, for example, if HUL, Hindustan Unilever Limited, is company that is hero and that is well established in FMCG from last I mean like 1 to 2 decades, 3 decades, then it will be keep going with the flow. Okay, then what are the benefits of investing? See, according to Peter Lynch, wealth creation is the first benefit of investing. That is, over time the compounding effect grows investments exponentially. For example, if you today invest $1,000 at 10% annual returns, it will become 10,000 plus dollars. It means more than $10,000 in just 25 years, like 10x in 25 years. No other investment class can give you this much return except stocks. Okay, or even like index funds. I personally consider mutual funds the best strategy for investment. Then learning about the economy. The one more benefit of investing is that you learn about the economy. You become a smart person. Okay, investing helps you understand how industries and markets operate. You regularly read those annual reports, you read the investors presentation, you read about the peers, the competitors, and you slowly you understand the industry and the market dynamics well. And this is also one of the major benefit of investing, that you become a smart person. And then supporting businesses. Here he says that by investing you contribute to companies solving global problems. For example, green energy. For example, today carbon dioxide emissions or global warming is a big problem. Now those companies which are uh, working towards green energy, you can invest in those companies, and thereby you can also contribute to the global in solving global problems. So this is also one of the benefit. Now what are the final thoughts? Final thoughts is that uh, here the author says that you should start as early as possible, otherwise compounding will not be much effective. Okay, see, the earlier you invest, the more time your money has to grow, and more time it has, it will grow more and more exponentially. Okay, and even small amounts can compound significantly over decades. Your small amounts, for example, your 1000 rupees, your 2000 rupees, it will grow into crores in 2 to 3 decades if invested in a disciplined manner. Okay, SIP, I'm talking about SIP, systematic investment plan. Now the second is stay informed. Okay, so read about industries. Whenever you invest, whenever your money is at stake, you read about that thing. Okay, you read about those industries, those companies, what are the market trends, and you also educate yourself on new investment strategies. So you stay informed, you become smart by investing and take action. So don't wait for the perfect moment to start. This is the moment, this is the right moment to start. Okay, so you should not wait, otherwise you will miss the opportunity of compounding your wealth. And begin with what you can afford and learn as you go. First of all, you don't need to have much more money, or you don't need to have big pockets so that you can start investing. You can start wherever you are. Okay, you can start from wherever you are. You can start with a much low money also, but the more important thing is to start. Okay, so that the compounding can take over, and begin with what you can afford as and learn as you go. So this was the summary of Learn to Earn by Peter Lynch, one of the best books. This book, I have also read this book. Okay, and personally I also consider uh, this book as one of the best books on finance. So tell me in the comments, guys, which book summary do you want next. Thank you so much. Bye bye.